Everybody. Today I want to talk about the Earned Income Credit. This is a credit for low and moderate income individuals with qualifying children and without qualifying children. My reason for wanting to speak about this credit is that it is very important to understand the rules and regulations behind this credit, as this credit seems to be the IRS's number one credit that is filed incorrectly, whether known or unknown, for specific reasons. And if you do receive a notice in regards to this credit of being banned from filing the credit, you can be banned for up to 10 years. It's more typically 2 years. The way that the IRS specifically states that is that if you file the credit and you had reckless or intentional disregards for the rules or regulations, it will be a 2-year ban. The other option is if you filed a fraudulent credit, that could be up to a 10-year ban. So again, there's some specific provisions within this credit, and you just want to make sure that you understand all those provisions prior to filing for this credit. In addition, typically the IRS does not open their e-file system for this particular credit until about mid-February, and that varies on an annual basis. So again, once their computer system is up and running and able to handle the credit, your return will be processed. Not to say that it won't go in the system and go in the queue for being processed, but your refund and whatnot will not get processed until typically mid-February under this credit. So let's talk about some specific components about this credit before then we'll get into as well as what happens if you end up getting banned from filing this credit or you receive a CP 775C notice. We'll talk about that as well a little bit later in the video, but for right now I just want to talk about how do you qualify for this credit. So some basic rules in order to qualify for this credit is you must have earned income, you must have investment income that is below the limit, you must have a valid Social Security number, you must be a U.S. citizen, you must not file Form 2555, which is foreign earned income, and you must meet other certain rules if you're separated from your spouse and not filing a joint return. So again, all those items will be items that you'll need to check the boxes for. So let's kind of get into the specific details as far as the number one area where people usually mess up in filing this credit and then end up ultimately getting banned from it. So that is with a qualifying child or relative in regards for filing the Earned Income Tax Credit. So there are specific tests that you're required to make if you are filing for the Earned Income Credit and you do have qualifying children or a qualifying dependent. And those tests are based off of, there's 4 components. So you have age, relationship, residency, and then whether or not you're filing a joint return or not. And we'll get into the joint return later. So that's a little bit different, but as far as the dependents, you have your age, your relationship, and your residency. So we'll jump into age. So again, in order to be considered a qualifying child for the Earned Income Tax Credit, the child can be any age if they are permanently disabled. And again, they have to fit the specific requirements of that permanently disabled. Or they must be under the age of 19 at the end of the year if you're going to file it if they're not a full-time student, or under the age of 24 at the end of the year if they are a full-time student, and at least 5 months of the year and younger than you or your spouse if you file a joint return. So again, full-time student definition. So in order to be under the age of 24, you must meet the full-time student definition. So to be considered a full-time student, the student must have enrolled for the number of hours of courses their school considers to be a full-time of attendance. Students who work on a co-op, jobs, private industry as part of the school's official program are also considered to be full-time students. So again, you just want to keep those are the 2 main ages to keep in mind. Age 19 if they're not a full-time student, and then age 24 if they are a full-time student. And again, just make sure that you specify that you're within, if they are a full student, they are considered a full-time student within their school. So to be considered a full-time student, again, these are a little bit less common. So it'd be an elementary school, junior or senior high school, a college or university, or a technical or trade school in order to be considered a full-time student under the Earned Income Tax Credit. Now, more typically, you'll be looking at a college, university, or technical and trade school. Some items that a school is not is an on-the-job training course. So again, you're not going towards, so an on-the-job training course would mean you're not going towards the getting a degree in something. So you're not going towards, getting a degree in English so that you ultimately become a teacher, becoming certified to be a teacher. You have to have some sort of level of progress towards getting a specific degree within a specific area, as well as obviously the school should be credentialed. Again, correspondence schools do not count, and then school offering courses only through the internet. Those also will not count in regards to the earned income tax credit. So again, if you attend a trade school, you're going to school to say to be an electrician or a plumber, those would also qualify. So kind of let's jump into the next category, which is relationship. So in order to be a qualifying child for the earned income tax credit, your child must be your son, daughter, stepchild, adopted child, or foster child. They can also be your brother, sister, half-sister, stepsister, or stepbrother, and then as well as a grandchild, niece, or nephew. So for an adopted child, we'll get into the definition of that. An adopted child is a child who is lawfully placed with you for legal adoption. And then a foster child, for the purposes of the earned income tax credit, is a state, local tax government agency, an Indian tribal government, a tax-exempt organization licensed by the state or Indian tribal government, a court order. So that you have to be assigned a child in order for them to be considered that through one of those agencies. The next item is residency. So, and again, in order to be a qualifying child, that child must live with you in the same home as you in the United States for more than half of the year. So, that's just kind of simple, just like that. So, there is specific caveats to this. So, for example, if your child is in college, it will count that they live with you for the year. If they're a full-time student in college and they go away temporarily to college to study and do what they need to do in order to continue maintaining their degree and maintaining their full-time status, they are still considered living with you in the household. So again, those items are considered living with you. There is temporary, so it's considered under the category of temporary time away from home. And again, those items are illness, hospitalization, school attendance, vacation, business or military service, detention in a juvenile facility, a kidnapping. Those would be items that would be specifically considered a temporary leave from home, and they are considered to be living at home with you at that point in time. Now, let's say hypothetically you have a child during the year. If you have a child in the month of December and that child lives with you at home, whether that be at home or in the hospital, they are going to be considered to be a dependent under the earned income tax credit. They will fit that residency requirement, and you'll be able to claim them as a dependent for that earned income tax credit, and they'll be able to be considered in that calculation. So the specific rule behind having a child birth in the year is for their life, they must live with you for at least half their life. So whenever they are born, if they're born in December, that must mean that they must live with you for at least 50% of the month of December. If they're born in July, they must have lived with you for at least 3 out of the 6 months out of the year, basically. So it's just they just have to be with you more than 50% or greater at the time. Let's jump down now to joint returns. So now generally, you cannot claim the earned income tax credit if you don't file a joint tax return and you are married at the end of the tax year. But again, there can be specific instances where you are filing a separate return and you can still file that joint. You still can file that for that earned income tax credit. And the way that you can do so is that you must be living apart from your specific spouse in order to claim that specific earned income tax credit. So just to kind of recap, you just want to make sure that your child fits under any of those specific categories. You don't want to grab a child that does not fit outside of those categories because, like I said, that's typically what the IRS is going to be on the lookout for. And a lot of people will say, well, how would they necessarily know? Well, you got to put your child's age on the tax return. Date of birth goes on there, as well as any earnings and whatnot that they had made throughout the year. The IRS will definitely be, aware of those components. So again, I strongly recommend just reviewing the components to make sure that all the components fit and that you are putting the right amount of dependents in case of the calculation of the earned income tax credit, just so that way you don't run into any issues. It always becomes a headache later on to run into issues, so it's always suggest take a little bit more time, spend a little bit more time just reviewing it. If you have any children that somewhat maybe are falling on the line, just make sure you go on the IRS's website and review some of the requirements. Now, I understand that majority of people will fall within the given. So you have a toddler or a child that's in elementary school and they live with you throughout the year. You're a typical married husband and wife or typical single mom, and you're able to claim that child every year as a dependent. it's pretty much, guaranteed open and shut that you're going to be able to claim that child as a dependent when it comes to the earned income tax credit. Now, where it gets a little bit strange is in regards to if, say, you're a single mom or you're divorced or, living apart, and you have an agreement with your spouse or your ex-spouse or just the child's father, mother, that you're going to claim, that each person is going to claim the child every other year. There may be an agreement, in place where somebody will claim 1 year, somebody will claim the next year. So you really got to make sure that, because not only court orders, you can have a court order in place, but the court order may not always follow the IRS rules. So court order needs to follow the IRS rules. So again, if baby lives with mom greater than 50% of the year, and the court order comes out and says, oh, well, dad can claim that child as a dependent, if that child does not live with dad for more than 50% of the year, then technically dad cannot claim that child for the earned income tax credit in the year he claims them. So you kind of just want to make sure that all those items are also figured out and ironed out, because I think that's a lot of the areas where the IRS will actually question it and verify, because it isn't really necessarily reasonable that every other year a child is going to live with the mother and then the child's going to live with the father. So a lot of times court orders will just split out the year and basically say, okay, odd years mom can claim them, even years dad can claim the child. So again, just be on the lookout for those and make sure that they fit under those qualifications. Is that biggest thing is living with you. You want to make sure that they are living with you for more than half the year if you are claiming this credit and you are considering them in with your credit. Because the worst case is you don't want them to disallow you, because the IRS can come back and say, well, hey, you blatantly ignored our rules and therefore we're disallowing you from the credit for 2 years. So now even if you have another qualifying child, say you got remarried, you have another qualifying child, and that one's, not obviously not excluded from it, and they determine that you claimed 2 when you should have only have claimed 1, they can disallow you for the entire credit for all your children, as well as other credits as well. So like the American Opportunity Credit, if you had kids that go to school. So it's just something that you just want to make sure you're on the lookout and you're not going down the road of claiming something that you shouldn't be. So let's get into some specifics as far as tax tables go for this specific credit, because again, it is lower to mid-income individuals, and it really is based on number of children you have. So it's, as you can see, which is why it's the qualifying for the number of children is a large component of this credit. So if you have 0 children, you can still claim the credit if you're filing single, separate, or head of household. Your total max income in order to get the credit is $18,591 for year 2024. If you're married filing joint, that max income is $25,511. If you have 1 child, your max income for single, separate, etc. is $49,084. For 2 children for single is $55,768. For 3 children for single is $59,899. And then for married filing joint, again, we'll go 1, 2, 3. So for 1 child is $56,004. For 2 children is $62,688, and for 3 children is $66,819. So again, following within those income thresholds will make you eligible for the credit, as well as the other components that I had mentioned. The investment income limit is $11,600, and then again, I can kind of just get into some of the max credits in relation to this. So no qualifying children, your max credit is $632. 1 child is $4,213. Two qualifying children is $6,960, and 3 or more is $7,830. Now that is for the year 2024, so that's the up and coming tax year that we will be filing shortly. And that's the max credit that you can get under that. Obviously, it can change based on your income limits and based on everything else that you have in your specific scenario. And this credit is actually refundable, so which means that you can have a 0 tax liability and you can still end up getting a credit. So you can essentially just get paid an additional amount of money to work your job. So this is why it's kind of one of those more scrutinized credits, because again, you're not just getting a refund for taxes that you paid in. You could be getting a refund for over and above anything that you paid in. So you can end up having a negative tax, if that makes sense. So basically, say you worked a job and you paid in $100 in taxes. Your total tax liability is just say a 0, and then you go and you figure out the earned income tax credit, so you get your $100 back, plus you get $42.13 for 1 child. You would actually get $42.13 plus the $100 you paid in, so you'd get $43.13 and you didn't even pay that money in for a tax. So that's really what it means to have a refundable credit. So a lot of times the IRS really scrutinizes refundable credits, and they want to make sure that they are legit, which again is why delayed filing is typically occurs. You can still hit the file button on your tax return, but like I said, they won't process and send a refund beginning typically until mid to late February. So just kind of keep that in mind when you're filing your return. You also want to make sure that you keep in mind you have some documentations. So again, your income is what it is pretty much. I mean, for the most part, everybody is going to get some sort of a tax form, whether that be a W-2 or a 1099, or multiple W-2s and 1099s. And those items are going to be reported to the IRS, and they will be within the IRS's system. So that is a little bit less concerning. Really, the level of documentation is going to come out is somehow you're going to have to confirm that your child's living with you. Now, again, like I said, I mean, typically this issue would arise when your child starts getting a little bit older, and they're maybe on the cusp of, the 19 or the 24 age limit, and maybe they're a full-time student or not a full-time student, and then that kind of throws them out of the credit, but you claim them as a full-time student when they're really not. Again, the way the IRS is going to cross-check that is that they may look for a 1098-T, showing tuition expenses. So if your child doesn't receive one of those, they may just send you a notice and say, hey, prove it that your child attended, say, a technical school, which may not send a 1098-T, whereas like a typical university college will send that 1098-T. So you just want to kind of keep that in mind. So those are kind of probably the key areas, as well as, like I said, if you have an ex-spouse or the child has their mother or father, and you have an agreement that each person claims them every other year, you just want to make sure that you have a level of documentation of the days that they lived at home with you. So what happens if you receive this notice? So basically what happens is you may receive a CP 75 notice, which basically means that, hey, you know what, we determined that you file this credit without considering the rules and regulations behind the credit, and we're going to disallow it. So you're not going to be able to file that credit for 2 years going forward. Now, if you disagree with it, and here's where the documentation comes in place. So if you disagree with it and you can support that your child lived at home with you for these following number of days, and it's greater than 50% of the year, which is the reason why you claim the credit, then there is a potential that the IRS can reverse that decision and actually go against and re-say, okay, you're good, you can file the credit again. Listed in that notice will list you the date that you are able to file the credit again. It will also mention if you need to file Form 8862 in order to refile that credit once you are become eligible again. But again, you just want to make sure that child is there and make sure you have documentation for it. I can't tell you, how many instances of individuals that end up having to pay this back. And then, especially if you're one of those lower income people, you receive the money, you get it, and you have to pay it back plus interest. It becomes a large burden, and it's just better off. I always like to say, just exercise on the side of caution. Make sure you understand the rules, the regulations. If you don't understand it, make sure you consult with a CPA or enrolled agent, somebody that's familiar with it, and can get you all the specific details behind it, as well as assist you with keeping any support in the event the IRS comes back at you and requires some additional support to support the credit that you took. Again, I just like to caution everybody, but if anybody has questions and whatnot, feel free to leave it in the comments. I can produce a future video on anything that anyone has if needed. But again, hopefully everybody found this helpful, and look forward to seeing you guys again. Thanks.